Now, the next one we're going to look at is what we call the long condor. So this is a different animal from the iron condor. And so this is a great one because it's going to give you bigger potential profit, but you're also got the credit spread side of it to kind of reduce your risk and give you more potential to take advantage of theta and volatility. And this will give you the positive theta return or positive theta. So what this is doing is combining buying and selling options. So it's going to be a vertical debit spread with a vertical credit spread. So, think about the iron condor. They both look the same when you look at the profile. They both look like that, okay? But the iron condor is going to be two credit spreads. So an iron condor would be short a call, long a call, short a put, long a put. Your maximum profit is your credit received, and this is going to be a negative risk ratio. So you're going to be actually risking more than potentially what you can make. Now, the long condor is a combination of a debit spread with a credit spread. So in this situation, we could have a long call, short call, so call debit spread, and then we add a credit spread, a short call, long call here. And what that does is it reduces the capital from the debit spread that we put up, and also increases our positive theta by selling the option spread there. And we've got a nice potential zone here for profit. And we've reduced the capital at risk, reduced our theta, and it's a great strategy. So it provides you a bigger profit zone, gives us positive theta, no time decay. These are really good for kind of 1 to 2 weeks out. So potential for high returns on very low capital at risk. So, when you do the iron condor, good for range bound, but your returns are going to be basically, at 40, 50, 60%, something like that. The long condor, 200, 300% is typical. So you can see this profile looks just like an iron condor, basically. So here's an example just of how this works. So this is Lockheed Martin, for example. This would be if you just call debit spread. So you go out and you buy the 307. Call right here, sell the 310 right here. So you've got a call debit spread. Now, if we want to reduce the capital at risk, increase our theta, so it's got a negative theta, we can sell an out of money bear call credit spread that constructs and makes the long condor. So that's going to give us less capital at risk, and also it's going to increase and give us positive theta from selling additional theta and volatility. So here we have the bear call credit spread to it. So it's very simplistic. So you sell here the 312 by the 315. So now we've got that credit spread added to it. That has a positive theta, see 67. So that offsets that negative theta. So you have either a small positive theta, and you've reduced your capital at risk, and you still have a great potential for profit, more so than if you did a credit spread. So here's what this one would look like. So when you wrap it together, so you've got that structure. So now you reduce your risk in this example down to $59, and you've got potential, if it goes out between your short strikes here of those spreads, to make $191, which would be a 327% return. You've got this whole zone in here, but that's your max. So it's a really, really good structure. Let me erase that. Here you've got that debit spread, and these are great for legging in, legging out. So we'll a lot of times leg these. So you might start out with a debit spread and then add the credit spread. So if you did the debit spread only, you've got the potential profit on that. It's a $2.50 wide spread. I should have done this ahead of time. $2.50 wide spread, and your cost is 99 cents, so potential to make $151. Okay, and then the credit spread side, you bring in 40, so you have got the potential to make $191 on that, which is a 323% return. Versus if you just did the debit spread, and you've got the potential there would be $2, you've got a potential to make 150, 149 on that cost of 99. So you see your return is about 2 to 3 times more return on capital from adding that additional credit spread side. Plus it gives you a positive theta.